All right. Today's Thursday, the 19th of December, and this is a recap for the stock market activities today. And folks, I got a good one for you tonight. We got an important day ahead of us tomorrow, so I'm going to try to wrap this as fast as I can. We got the PCE tomorrow, which could be a market mover if there's a big surprise, specifically after the FOMC when we priced in higher rates. PCE could come out tame and change the picture a little bit. We also got consumer confidence, and that comes with inflation expectations, and that could also be a market mover. On top of that, we have, of course, the VIX being elevated, and we have OpEx, about $6.5 trillion worth of expiration coming out tomorrow. On top of that, we got some breaking news about the policy today, but one step at a time. Let's begin with perhaps the shortest morning brief that I gave. Today said all that you need to know, and I gave you a chart of J&K. J&K was down, the SPY was up. What is the message here? You got no confirmation for any rebound. You got no confirmation for any risk off. So long as the J&K is going down, we got more downside. Show me the moment when J&K rebounds, I'd say okay, we're due for an oversold rebound. But let's segue to the important breaking news that we got today. So I was watching before I jumped in here, I was watching this House vote for the government funding. And we got the results. And the answer is no, we have no deal. So apparently right now we have a government shutdown looming. Now, is a government shutdown a big deal? No, it's not, because it's going to be resolved sooner than later. It just means two things. Number one, more volatility in the stock market. If you experienced the last shutdown during the Obama administration, I think there was one under the Trump administration too, but it was mild. The big one was under the Obama administration. And I remember those. We went down a little bit, then we came back up again. But that means that that's going to add a little more volatility, and of course, it dropped the futures down as I'm looking at them right now. The second point, perhaps more important and long-lasting, if we're going to have a smaller bill for it to be passed, then that means less spending in the economy by the government. That's going to impact the unemployment rate, because a lot of the jobs that we have created, quote unquote, created in this economy were due to government spending. Eliminate that, you're going to see a reduction in the jobs created, and we'll see higher unemployment. Likewise, perhaps more important to the market, if we have a smaller budget, the likelihood is we see the dollar and bond yields retreating a little bit. And that's going to open up the market. The stuff that went down big, the Dow Jones, the value stuff, might begin to catch some relief. And even the indices might catch a relief. So the way I'm thinking about it right now, suppose we open tomorrow with a flush down, because the futures are already down. We're probably going to see more puts that were bought yesterday and today, doing sort of an inverse gamut of the market maker. Suppose we get a flush tomorrow. I think over the weekend they figure out a deal, because you have the Christmas holiday travel season, and if you shut the government down, you're going to cause a lot of chaos. And that's not popular with the voters. So we're going to find a deal over the weekend, smaller budget, and then what do you know, next week we see the dollar down, bond yields down, and the market rebounds. I'm just thinking out loud right here. That doesn't mean that's going to happen, but it is something that I'm looking forward to. Now, another important thing that we got to cover is this move that we've seen in yields. I mean, absolutely stunning. This is the biggest move that we've seen since, some of you remember, the taper tantrum, 2013. That was an ugly year, but of course, at the end of the day, Bernanke had to cave and rescued the market instead. And now we have these trillions and trillions of dollars in debt as a result of that decision and what followed thereafter. But again, sharp moves in bond yields, and this is yet not as sharp as the 2013 taper tantrum one. We're about 10 basis points. That one was over 15 basis points. What I'm trying to say is we could see bond yields spiking higher again, let's say another 2, 3, maybe 5 basis points. The likelihood is after that we see a big drop in yields. That's what usually happens. There is a resolution, and I think this is what supports my theory, that we could flush down tomorrow, then we get a deal over the weekend, then yields go down Monday, and we begin what's known as the Santa rally. It's not going to be really a rally, it's just going to be maybe a little bit of a recovery after the hit that we just got. Most importantly, as we begin to prepare for next year, look at the implied rates ahead of September FOMC. They were anticipating that by Jan 2025 will be at 4% already in the federal funds rate. By the end of the year, 2025 will be below 3%, closer to 2%. After the commentary by Mr. Powell yesterday, you can see that the rates will probably settle down at 4% by the end of the year, next year. And I would say probably higher. That's a huge change. That's a huge recalculation of all of the pricing that we've done in the market. And of course, that's going to open up the possibility that we might just erase the entirety of the post-election rally, because it's not just a change in the monetary policy outlook. It is also a change in the sentiment. The post-election rally was stupid to begin with. Oh, the orange man is going to do this, going to do that. We're just speculating on what's going to happen and pumping valuations to insane levels. I said at some point, once we're done looking at the glass half full of the Trump administration, we're going to look at the glass half empty. You're beginning to see that a little bit. The trade wars, the tariffs, the tax cuts, the budget deficits, and again, the shutdowns that we're going to see, and the battles that are going to happen time and time again. And once we begin to concentrate on the glass half empty, things change, and I think at the end of the day, we neutralize the entirety of the post-election rally. Another important thing, and I think this, for me, this what really did it. When he said it, actually, I was listening to Powell. When he said it, I immediately was alert. Did he really say that? When he said that, oh, we're actually closer to the neutral rate. Wait a minute, you've been talking about, oh, inflation is going to crush, we're going to cut rates and all of that. Now you're talking about we're already at the neutral rate, or close to it. So you see the federal funds rate right now under 4.5%. You have a low estimate of the neutral rate because nobody knows that. This is what we call R star. And a lot of theories about it. Most of them are false and not really applicable. It's really an art more than it's science. So you got the low estimate at about, let's say, 2.5, but the higher estimate is moving higher, and it jumped higher after Powell's commentary to the point where it's now getting closer to meeting the actual federal funds rate. That suggests that we're probably not going to see any more rate cuts if that is the case. And that's a big recalculation from what we got before we hit it to the FOMC yesterday. Now, the good news is, if you're looking at the economy, the good news is, look at this chart right here. Every time the Federal Reserve begins to cut rates after they've been loosening the rates because of inflation, you see the case in the late 90s, the case of 2008, the case of the pre-pandemic, and now the case that we got right now. The moment the Fed begins cutting rates, that's the early signals that we're going to head into a recession. So if the Fed is going to be tighter with the policy and not cut rates, that tells us that the inflation risk is higher than the recession risk. And it delays that recession so long as the Fed is not cutting, because we know that the Fed only cuts for the wrong reasons. And Mr. Powell doesn't want to get that lesson to his head. He's going to learn it the hard way. The Federal Reserve doesn't cut rates for good reasons. If you do them, you're going to have inflation as a byproduct. You only do the rate cuts for the wrong reasons, to rescue the economy. Now, what does that mean? If we're not going to concentrate on recession anymore, or maybe concentrate more on reinflation, the market is already speaking, folks. The market is already saying that recession stocks, you look at the staples, you look at the utilities, you look at real estate, anything of the dividend-paying stocks that we consider as recession stocks, been absolutely creamed as of late. And the reason behind that is bond yields are going higher to the point where they're making dividend-paying stocks, the safety defensive stocks, are unattractive. But why are yields going higher? They're going higher because of that reinflation risk. So I get a lot of questions. And by the way, I said here, before the storm hit, I said, if you have a dividend portfolio, please hedge your portfolio before the VIX begins spiking. I said that repeatedly in the program. Some of you did not listen. But the point being is, the stuff that is betting on a recession, like the dividend-paying stocks and the quality defensive names, have been suffering. And the stuff that was betting on reinflation has been hot and will get hot. But at some point, of course, as rates continue to go higher, we're going to run into problems and reintroduce that recession risk again. Yields will go down, dollar is going to go down, and the dividend-paying stocks will be hot again in 25. So you got your boy Tom Lee. He comes out today and says, back up the truck. Wednesday's panic selling is a buying opportunity. You got to go all in and buy the dips. I would say, look, if I'm watching what's happened to value stocks as of late, it's an absolute massacre. And value stocks right now are the cheapest in about 40 years. And I think that they're going to offer a lot of buying opportunities in 25. Because once we switch back to that recession risk, and we see bond yields coming back down, these dividend-paying stocks are going to appreciate handsomely. And now they're getting cheaper and cheaper by the day. Entries, always tricky. If you enter in the wrong time, you're catching a falling knife, obviously. So you have to be really careful with that. You have to find out where the point is, where we see yields reaching a ceiling and beginning to reverse, which we're not seeing right now. We will see, let's say, temporary pullbacks in bond yields. And that's going to lift up these value stocks and dividend-paying stocks. But I'm talking about trying to time the exact moment and the time where we see the 30 bond yield, for example, topping and reversing for good. that's the moment when we see a lot of these yield-paying stocks leading the market again. And if you go back to the dot-com example, in the aftermath of the bust, technology stocks went down 80%. But then you look at the dividend-paying stocks and the classic value stocks, they began to thrive. There was a rotation after that. But of course, the value stocks have lesser rating in the indices, so the indices looked bad. But under the hood, value did outperform. And I think this is going to happen in this cycle too. So keep that in mind. That's one of the strategies that we have to keep in mind in 2025. Now, what is immediate for tomorrow's session? Well, we got quad witching, or triple witching, is it? Triple witching. We're talking about $6.5 trillion of equities alone expiring tomorrow. So it's a huge one, and you see it in the index options, about $4.4 trillion in notional. Options and futures, so not as big. The ETF's not as big, but it's the index options that are problematic, $4.4 trillion. So the majority of the moves and the juiciest moves will happen in the index level tomorrow. Not in the single stocks, because that's $690 billion, which is small in comparison with the $4.4 trillion in equities. How about the skew? The skew is leaning toward calls. The bias has been toward calls. So we see more and more calls in the open interest versus the puts. And that's for the single stock complex, which also gives you a little bit of an idea of what the indices look like. Bottom line, the risk for a squeeze is in the calls side, just by looking at the skew alone. But you got to put it in perspective, folks. And again, I don't want to spend a lot of time doing this because all of this is going to be changed and updated in tomorrow's session, say an hour after the open. What's going to happen is we get the updated open interest change and the new numbers of the open interest. And that will give you the clarity of where the max pain is, the squeeze risk. But let's speculate based on the data that we have today. I want to make out a point here that today implied volatility went down. So the market maker already sort of exercised some max pain today. Because both the calls, look at the change. The calls are down, and you'll see the puts in a minute. The puts were also down today. So the market maker neutralized a lot of positioning today. There was a little more to do tomorrow. So let's identify the squeeze risk in the calls and then in the puts, because it's not going to be more about max pain tomorrow. It's going to be more about who's going to squeeze who, the calls or the puts. If we open ugly, then the likelihood is it's going to be in the side of puts, because you're going to see more puts already in the money and the market maker being forced into an inverse gamma squeeze. But anyhow, we begin with the calls. Where do we see the highest open interest? And the volume also matters, because the volume, that's going to include the buying and the selling. So when you see higher volume, there's probably a change in the open interest coming out tomorrow, either adding or subtracting. We don't know yet. But if we look at the highest open interest, the squeeze scenarios, in the call side would be 590, which is, again, that's not a big squeeze that can happen right away. But the real squeeze, and we talked about this in the stream today, it'll be 595. And that's going to be an upside of about 1.5% in tomorrow's session in the SPY. But that's only going to depend on a lot of factors. The open really matters, the data, the PCE, the consumer confidence, all of that matters. And what matters is, do we see the puts closing right away or adding? Because if you look at the point where we might find support in the calls, meaning if we drop down, the market maker doesn't want to go below that number. That'll be the highest number of open interest in the money, and deeper in the money, that's going to be 580. So we don't want to drop below 580 if you're the market maker in terms of calls. Let's see how the puts are looking like in terms of the squeeze risk. The squeeze risk in the puts is exactly 580. So if we have a squeeze in the put side, it might take the SPY another 1% down to 580, but you're probably going to find support at 580 unless we see more and more stampeding and buying puts and the VIX exploding higher. Then it could get really ugly. But the expectations right now, based on the data that we got, 580 should be a good support in the case of a put squeeze. What is the maximum pain? The number where the market maker want to park flat at to make sure that the majority of the calls and the put side of the money expire worthless. The number is 585. 585 is just a touchdown. It has a high number of open interest and volume in both the puts and the calls. So parking at 585 is what the market maker wants to do, ideally. But depending on the flows and how we open in the morning, you got to consider the squeeze risk that we talked about in both the calls and the puts. Now you know. Of course, I didn't want to spend a lot of time on this because based on the change in open interest tomorrow, the numbers could change. The good news, I'm going to be in Discord, and per usual, of course, every Friday we do this. I update you with the max pain numbers and the squeeze risk based on the data that we get in the morning, about an hour after the open. The other good news is you're getting a morning brief tomorrow with at least some trading ideas. The bad news, though, we're probably not going to be able to do a chat session or a stream because I'm flying tomorrow, East Coast in-laws, you know the deal. And my dear and endeared wife doesn't want to arrive late, so we have to fly a little early here. In any case, only if there is, let's say, a massive hit right in the morning, we see the indices down more than 2%, then I'll probably have to do a stream really fast. But absent of that, I'll give you the morning brief, I'll give you the max pain numbers, and then I'll be back again because I'll be on my way in the plane. So I'll give you before the close any trades based on that morning brief and based on the action that we got. So we'll give you the trades for the options tracker for the expiration date of Jan 17. We'll give you a series of those trades. And I'll give you also any ideas that I have based on the close and the action that we see tomorrow all the way till the end of the year. So I guess the majority of what I'm telling you right now is actually good news. We only have one bad news, which is probably no stream and no chat session tomorrow. For now, this is what I gave you guys today. I said that tomorrow I'm going to add TSLA calls because the IWM been weak and yields are going higher, so we could see more pain happening in the IWM. And I suggested that a lot of you who've been short the IWM, you made 100, 200, 300% in certain cases worth of profit that I've seen so far. And I suggested, look, you're up 200, 300%, you got to book some profits. And if you still want to preserve a seat in case the IWM flushes down tomorrow, let's do it via TSLA calls with a tiny little portion from the profits that we got in the initial puts on the IWM. That's the right strategy. Now, I got the 590, 585 SPY puts with the expiration date of tomorrow. We closed that today at a profit because there's no point of assuming the risk, just in case there's a rebound tomorrow. But I'm keeping 585, 580 SPY puts for next week because I got time on those. Of course, if something happens tomorrow, such as a move higher or I see a risk of a squeeze higher via the calls, I'll abandon that really quickly. And then we have another deeper position, which is the SPY puts for Jan 17, that is, it's the 575 puts. That is a more of a serious built-in position. And the bet is that we erase the entirety of the post-election rally by Jan 17. What if we see a squeeze by the calls, though, right off the gate tomorrow? This is why I said that we're going to go with the SPXS, 6.5 puts, expiration date tomorrow, it cost about 20 cents. So if we have a move higher tomorrow, the SPXS puts will pay me, and that's going to compensate for any loss that I get in the 575 puts for Jan or the 585, 580, and it gives me a little bit of time for me to be able to reconsider and manage these trades rather than, making a knee-jerk reaction because you're down in the position and you're panicking. If you have a hedging policy, at least you're muffing some of the pain. That gives you a little bit of time and rationale to reconsider and reassess your positions. Now, to investors, I think it's going to be an important day tomorrow because based on the changes that are going to happen in bond yields and the dollar, as we discussed before, certain portfolio moves will open up. So if I see those two, I'm going to let you know the names that I'm buying because I might buy some stocks tomorrow. So I'll give you those names before the end in Discord. But with that out of the way, folks, let's move on here and segue to the market information, add more color to the conversation that we just had, beginning with the closing of the indices. And here we go. The diamonds barely in the green by 15.37 points or a gain of 0.04%. The Nasdaq down beat flattish 19.93 points or a loss of 0.1%. S&P 500 down 5.08 points or a loss of 0.09%. The Russell 2000 the biggest casualty because really sensitive to yields and yields are higher again today. So the Russell is down about 0.98 points or a loss of 0.44%. Looking at the sectors, really interesting. Utilities, which is the defensive, went higher, but there's a catch. I think that we had some earnings from utilities and we had some of the AI power kind of play ongoing in utilities. That's going to remain hot, by the way. You might have heard the commentary by Microsoft CEO Nadella, and he said that we're not spending more in chips right now. We have capacity. We've accumulated a lot of supply. What we need right now is power. So we're spending more in power. Now, that's a warning sign for NVIDIA and Taiwan and all of the chip cohort, but it's good news for these power generators. I think that was a lot of the reason why we've seen utilities going higher. Now, as far as financials, the thinking is we have a steepening in the yield curve, so the algos pick up on that and they pump financials, but they faded at the end of the day. So you got to be careful with that. The same thing with technology. The VIX was down. It went 70% higher yesterday. It has to come down a little bit. And because it came down, the algos pumped the big caps higher. So the majority of the gains that we got today were based on the algos. But boy, do we see massacre in real estate and metals and healthcare and defensive and energy. All of these sectors are just getting hammered. Anything that value, anything that pays dividends is getting absolutely killed as yields continue to go higher. What about the breadth? Improving a little bit, which is a bad sign for anybody betting on maybe a rebound tomorrow or a move higher tomorrow because the breadth was absolutely awful during the massacre. But we fixed the majority of that. we're now back to neutral. So you see the NYSE 40% advancing, 59% declining, the NASDAQ 43% advancing, 54% declining. That opens the path that we could see ugly breadth in tomorrow's session again. If we closed with an ugly breadth today, with another, let's say, 10% advancing or 20% advancing versus the rest declining, I would have said, okay, tomorrow we're going to squeeze higher. But because of this, it keeps the downside momentum open. Looking at the heat map again, it looks like a Christmas tree here. It's red there, it's green here. But again, go back to the conversation that we just talked about in when we looked at the sectors. The algorithms see the steepening of the yield curve and they go ahead and buy financials, specifically JP Morgan, because JP Morgan is the biggest benefactor of higher rates. The thinking also goes that if we have higher rates, that's going to be good for the credit card companies like Visa, MasterCard, Amex. But higher rates will also mean weaker consumers, so I think there's going to be some reconsideration about all of that. So Visa might go down, but Amex might remain hot because that's the higher end consumer. The algos also moved the big caps a little bit higher today. Amazon, Nvidia, Apple managed to close positive because the VIX went down. We see the airliners also rebounding before the travel holiday season. I mean, we already pumped them higher. What are you looking for at this point? The home builders down because of yields. Anything that is yield sensitive like real estate, home builders, defensives, energy, metals, all of them are down. The dollar was higher, so anything in industrial that is reliant on the dollar was also down. A lot of the names in healthcare were down. But we have Merck rebounding. That's the good news. Merck is buying a Chinese weight loss pill, which could be a big deal. So that's good news for Merck. Then we have Amgen went down again, but I'm buying more Amgen. I think that these two names, Merck, Amgen, and possibly Pfizer, will begin to compete and acquire market share in a really lucrative market away from Eli Lilly and NVO. Looking at the heat map for the ETFs, TLT down 1.5%, so yields are going up big. So right off the gate, anything that is yield sensitive not performing, with the exception of utilities, the defensive utilities, because of the reasons that we just talked about. But it is a massacre in the XHB, ITB. I mean, it's absolutely ugly. And the dollar was higher, but we see some stability in gold, not the gold miners or SLV, but gold, GLD. So that could be a leading sign that we might be closer to a pullback in the dollar. Of course, the dollar going higher, yields going higher. We see de-risking in cryptos. And you see IBIT, beta all down. And I think, folks, if we're going to erase the entirety of the post-election rally, we will see a big flush in Bitcoin too. What's really interesting today that despite the dollar going higher, international markets caught a bid. So Chinese YINN or FXI with the EWZ up about 2%. Can we continue in these moves higher in international markets if the dollar continues to go higher? The short answer is no. So you need to see the sustainability depends on the dollar going down. Looking at commodities, we only need to see the weekly performance here, folks. We don't need to waste a lot of time because so long as the dollar is going higher, there's very little you can do with commodities. They're all going to go down, the exception Nat Gas, the party boy, which is up so far about a little over 10% for the week. And that is because the seasonality. And then we got the three Amigos, OJ, cocoa, and coffee. Those are positive. Those are defying the strength in the dollar because they have their own production and crop kind of problems. Supply versus demand, which just favors demand over supply. Lumber, we'll see what happens here. There are a lot of stories about, generating AI power via lumber and all of that. So we'll see if that's going to cause lumber to move higher and join the three Amigos. But the rest of the futures and commodities are absolutely ugly. Massacre. Moving on to the big casino, the options market, what do we see here? Right off the gate, I see that we're beginning to buy puts, Johnny come lately, which we could squeeze a little more, but it tells me at least in the short run, if we flush down tomorrow, midday or guaranteed Monday, we're gonna see a rebound. It could be steep, so we have really juicy trades for you here. Fingers crossed, of course, that we get that scenario. I'd love to get it. Flush it down tomorrow, let's make some money from the puts. And then we switch to buying some dips for the rest of the year and maybe maintain some longer puts and add to them later. We'll talk about all of that in tomorrow's session, but the fact that we see elevation in the puts versus calls, it tells you that we have a lot of Johnny-come-latelys, and that increases the risk of the VIX actually going down. The IV ranks beginning to get hot. We no longer see 5% or 2%. We're now seeing double digits across the board, so hedging is getting more expensive. You guys should have hedged when I said you should hedge. When nobody wanted to do so, everything was cheap. Now it's paying off. But what stands out to me here is Tesla at 88, let's say 90. This is getting really close to ending the volatility spike on the way higher, which means that the stock is getting ready and closer for a reversal point. That's the good news. If you're a Tesla bear or you're betting against Tesla, via puts or otherwise. The bad news, as Tesla begins to reverse, the implied volatility will go down. And you're going to need bigger drops to make money from the puts. Because sometimes you see Tesla down 1% or 2%, and your puts are actually down in value because you overpaid for them. So in these kind of scenarios, we want to finance the put by doing something such as a spread or selling a call credit spread. That way you're exploiting the implied volatility before it goes down. The other approach is opening the puts longer term via increments. That way you can sort of extend that implied volatility and you're not subject to the near implied volatility, which is usually higher. It decreases the chance of you overpaying for the options. But anyhow, let's move on here to the flows. Bullish flows today in AMD, Coinbase, SPX, Cash Index, Oxy. A lot of interesting stuff in Oxy, even though I am not a fan at this point. IWM, VRTX, Merck, regional banks. And the bearish flows for ASHR, China. Microsoft, MDB. A lot of you love to trade MDB, bonds, CrowdStrike, Palantir, UPS. Interesting, but the bigger flows here are calls, or let's say closing a lot of puts today. In the SPX, the volume, the bullish volume was over $3 billion. Let's do some of the unusual activities, and we begin with the Dow Jones DIA. It makes sense, folks. If there is anything that's going to rebound hard, once we're done with the flush and the spike in volatility and the spike in the yields and the spike in the dollar, if there's anything that's going to rebound hard, it's going to be the Dow Jones. So I am supportive of this trade, but I mean, the entry is always tough, folks. They're losing here. They're down about 12% in the trade, so you're never going to get the entry correct here. You're always going to miss it, but the hope is that you're close enough. I think it would have been better had they waited for tomorrow to open this trade, but the idea remains the same. The 440 calls for February 21st, 2025, spending about $1.75 million. Why do I say, by the way, Dow Jones has the possibility of rebounding the hardest? Because if we have a rebound, it's going to be because of a reversal top, at least near-term top, in both bond yields and the dollar. And the rise in the dollar and bond yields been behind the crushing of the Dow. But this is the only bullish one that we got. We got plenty bearish ones on the SPY bear put spread. This is more immediate for now. 585 puts, and they're opening the 577 puts on it as a spread. So they bought 585, sold the 577. The expiration date is for next week, December 27th. So again, anticipating maybe another flush in the SPY here. Spending about $3.6 million. And they're doing the same thing in the Russell 2000. Even though a little longer for its expiration date, 209 puts for Jan 17, spending about $1.75 million. IWM is not going to rebound until we see a top in yields and a reversal. And by the way, they bought more of this. It ain't just the $1.75 million. They bought another series of those 209 puts, spending an additional $1.5 million. Now we have AVGO. This is really interesting. AVGO, Broadcom, somebody bought the 150 puts. The expiration date is April 17th, 2025. Spending about a little over $4 million. They're already up on the trade, so it's interesting that we're fading the entirety of the pop here in AVGO. It's beginning to look weak. So is the analysis that we've done beginning to sink in? That you can't really say that AVGO is undervalued based on what's already done. Anyhow, the last one here, bearish one, is for the VIX, which I guess it is bullish. Somebody's betting that the VIX is going to go down or retreat the majority of the pop. They bought the 17.5 puts, the expiration date Jan 22nd, 2025, spending about $2 million. This trade makes a lot of sense if you short the SPY. If you're betting on a flush down, this makes a lot of sense as a hedge, that you bet that the VIX is going to go down. You could play with the expiration date and the strikes, but the point is, you got to have a hedge. If you're buying, like me, if you're buying the Jan 17 puts on the SPY, tomorrow I got the the puts on the SPXS as a hedge, and soon enough I might just buy VIX puts all the way to Jan 17 as the hedge against that position. Let's do some charts and then wrap it up. We begin with the SPY, an hourly chart. What do we see here? What we see is we failed to recover. We gave it a shot twice at 591, couldn't happen. We never got a close above 591, so no confirmation. And we went down to retest 585.89, which is the low from yesterday. We ran out of time before we get the resolution. Closing above or below, I think that the fact that we came back down means that we're going to head below 585.89, perhaps right after the open tomorrow. We'll open lower. Now, if you look at the RSI, it was overbought, but after the attempts to crack above 591, we've solved some of those oversold. We're still oversold, but not severely oversold, Meaning, can we get another flush? Yes, we can. And the hope is we don't see a gap down, a big gap down, because if we see a big gap down, we're going to open really oversold, and then we'll see the opposite reaction. And we missed out on that trade. I want to open a little down, just to increase that inverse gamma risk, and then enter short-term trades like I did yesterday on the SPY with the 0 DTE or Monday's expiration, and juice up some of that increase in the inverse gamma, and then switch to the calls later in the day. Fingers crossed, because if we do it, it's going to be a big score, and I'm waiting for that. But if we open gapping down big, I think it's going to ruin a lot of it. But at least I got some exposure. If we look at the daily chart for the SPY, we broke trend, so now we have 576.70. That's the gap from the elections. Let's just do that, close it. Let's flush down, folks. In tomorrow's session, close the entirety of the November pop, and then we're going to rebound later in the year in what's going to be as the Santa rebound. Forget about Brandy. It's Santa rebound. Now we can also see that 576.70 is in or around the 100 days moving average, so it makes sense as a good support to rebound from. If we plug in the 50, we're already broke below the 50, so that's a bad sign. Another day below the 50 means that you're probably going to head lower looking for support. Plug in the Bollinger Bands. That's the only problem here with more downside, but can we squeeze one more? Yes, we can. And then it's going to be an obvious buy of the dip. The E-mini futures weekly chart, we're breaking below the rising wedge. So this is a bearish breakout, a topping signal, which means on the dailies, you can get rebounds, but in the weeklies, we have probably topped here in the S&P. The Q's hourly chart, what do we see here? Unlike the SPY, we tried a rally here at 520 and we failed. And then we closed below the low from yesterday, that's 517.15, so it's more bearish than the SPY, and it's susceptible to opening lower. Again, the hope is we open lower just by a little bit, not down like 1% or 2%, because if that happens, the obvious trade will be buying the dip right away. But right now, support 511.45. After that, we have 506.41. We'll talk about these numbers as they happen on Discord. Now, looking at the daily chart, we're almost at support. So whether support is going to hold or not is really important, because if it doesn't hold, if we open below, that means that we're probably not done with the downside in the Qs. We'll probably have to go down to close the gap right here and do what the SPY is going to do, which is erasing the entirety of the post-election rally. Now, in the NQs, the NASDAQ futures weekly chart, we're also breaking in this rising wedge pattern, also closer to confirmation that we have a top in the Qs, but it's more obvious in the SPY. If we do it, we are likely to find support in the near term at around 20,522. And after that comes the trend line. The Russell 2000 daily chart, what do we see here? Yields keep going higher. This guy's going to get creamed. Why not extend that flush one more day? Let's revisit the trend line in yellow, or it coincides with the 100 days moving average in red. Let's do that and then get a rebound after that. The dollar. Momentum is turning positive. We're above the previous high, so the risk remains to the upside. Of course, there's a possibility that we could reverse because the RSI is way overbought right now. But the momentum is definitely on the side of the dollar until proven otherwise, which means the metals are going to get hammered. Among them, of course, the old man. The old man is now flirting with 2,600. And the old man doesn't want to break below 2,600 because that's going to open the path for more downside. So gold is begging the dollar here. Please go down tomorrow so it can move higher. The bad news for gold is if we look at the gold miners, this is a weekly chart. We have a topping and a shoulder. We broke below the 50 weeks moving average. Now the next stop would be the 100 weeks moving average. So I think, unfortunately for the gold miners, we have more downside to come. So if you long gold, GLD, the commodity, or physical gold, I suggest that you buy some puts in the GDX, go all the way to Jan, and target the 32 line as a target. You can also do what I've been doing, which is the SLV. But today I closed my hedges using the SLV puts because we went below the 200 days moving average. That's an orange. And plug in the Bollinger Bands, we got below. So there is a possibility if you're betting on a rebound in metals tomorrow and a retreat in the dollar, SLV is the way to go. If you're hedging against your gold position, where you see more downside coming in metals because the dollar is going higher, you're better off buying the puts in the GDX. Clear? I hope so. What about light crude oil? Right now it's below the 100 days moving average, but it is consolidating in what could be a bull flag pattern. And we looked at the relationship between crude and the dollar. If the dollar keeps going higher, we're probably going to see crude also following. What do we do, though, with energy stocks? They've been getting creamed. I mean, look at ExxonMobil here. The commodity is going higher, at least holding. The results are getting better. The guidance is better. Why is it getting hammered? Because we're divesting out of all of the value, all of the dividend-paying stocks because of the rise in bond yields. So to a certain extent, the bottom in Exxon depends on a top in bond yields. But I think that we're getting close, and I think as an investor, if you look at the last flush that we got in Exxon, it was followed by a rally. So if you're an investor, I'm not worried about the drop in Exxon. I'd actually look at it as an opportunity to buy more to the position. But if you're a trader and you got the time limitations by the expiration date, yeah, it's going to be a painful trade because you're trying to speculate in the bottom and catching a falling knife instead. We see that situation happening all over the place. So you're better off, if you're a trader, to wait for top in bond yields, at least short-term top, before you begin to trade calls in Exxon. If you're an investor, if you're buying calls because you want to convert into stocks, you're okay. You just need longer expiration dates. I think it's going to be rewarding at the end. The problem, though, if you look at the weekly chart here in the 30-year bond yield, it looks like an inverse in a shoulder, now challenging not the shoulder line, but the neckline. We're already kind of above the neckline, to be honest with you. But we have resistance at the previous reaction that I'm pointing out right now. The odds would say, looking at the momentum in the RSI and the MACD, sure, you might get a pullback in the daily 30-year bond yield. But on the weekly, boy, it looks like we're going to retest the highs. We're talking about the ultimate highs. We're talking about the highest mortgage rates in the cycle. What is J. Powell going to do about that? That's the kind of stuff that pushes the recession risk higher if yields continue to go higher. And you're seeing the damage right away in the XHB home builders. It's an absolute vicious flush that we got as of late. But again, folks, I've been pointing this out for you and suggesting that you buy puts in the XHB for weeks now. If we get another flush down, which is my preferred scenario, let's get another flush down in the market all in all. Let's fill the gap in the XHB that I'm highlighting in the chart. And then it's going to be an easy buy the dip. Tomorrow before the close, easy buy the dip in the XHB. Because they're going to do something over the weekend with the budget, and dollar goes down, yields go down, XHB rebounds big. But again, does the market maker makes anything easy for us? Not really. They might be cute tomorrow and bounce the XHB, then drop it later. That's going to be too complicated to trade. The easier one would be flush, then rebound. The IYR is flushing indeed. If you look at the daily chart, we're below everything pretty much. We have support at the gap, which also coincides at the 50% retracement in the Fibonacci. That's going to be 88.46. Again, why not get another flush? Yields spike in the morning, we get another flush, and we hit 88.46. Then we begin to buy the dip in the IYR. These are ideas that I'm trying to brainstorm for you for tomorrow's session. All will be updated in Discord, but the KRE, what is regional banks, it tried to rally with JP Morgan earlier, but it failed because higher yields are good for JP, not good for the regional banks. So now finally we see the market being rational in differentiating between JP Morgan and the regional banks. But are they oversold? Yes, they are. 59.59 already hit, and we got the 100 days moving average of support. So there is a possibility here that the regional banks could rebound. What about China stocks? Alibaba weekly chart flirting with losing and closing below the 100 weeks moving average. We still got 1 day left. If we close below, you gotta hedge or exit because it's gonna get ugly all the way till the elections, or the inauguration, I should say. If we close above the 100, then okay, the hope remains alive that we're finding a footing in the Chinese stocks, and higher we go later on. The VIX daily chart, what do we see here? See, the risk that I see from today's move, where the VIX is up 70% the day before, and then we go down 20% plus the day after, it tells me that we pulled back so we can recock the gun and shoot it higher again in tomorrow's session. If that is the case, we could be back at 30 before we see a legitimate short-term top in the VIX. It retreats and the indices begin to recover. That's the preferred scenario. That's what I'm looking for. But again, the market maker doesn't make a lot of things easy for us. Bitcoin Apple, it is beginning to reverse. I mean, you see it in the MACD, you see it from the wicks and the candlesticks, you see it in the RSI with the negative divergence. But your confirmation will be a daily close below 245.50. That's going to be your confirmation. Your confirmation on NVIDIA, the down we go, is if we lose and close below the 100 days moving average. Then that's going to increase the odds that we're going to head down to 120. You can trade those 120 puts. You can do spreads on them, but 120 will be the target that we're looking at. The souffle Tesla, a little bit of a rebound today, but it's not oversold anymore in the hourly, which could open the path for more downside tomorrow. And we can argue that this could be a bear flag pattern. If we close below 417 tomorrow, it's a confirmation that Tesla's going to continue to flush. It's going to be one of the weakest names heading into the year end and in Jan, leading to that earnings report. We might see the market beginning to recover by year end in the Santa rally. But if this guy loses 417, the weaker hand that entered recently will have to scramble and sell before their gains turn into loss. And that's going to push the stock down. But 417 is the magic number. In tulips, what do we see here? We've broken trend, and it appears that we got a false breakout. A lot of you, congratulations to the folks who pointed that out. And again, usually the weekly chart's more important than the daily. So in the weekly, we never had really a close above. And the weekly was overbought, so it could get ugly here in Bitcoin, folks. If we see the SPY erasing the post-election rally, you're probably going to see a steep downturn in Bitcoin. Keep that in mind. Let's segue to the conclusion of this video. What do we have in the economic calendar tomorrow? We got a bunch of Fed zombies talking, but then the most important piece of data is the PCE. That comes before the open, 8:30 Eastern Time. That's going to have an impact. But if it is plain vanilla, no surprises at all, then the concentration goes back to OpEx. Then after the open, we got consumer sentiment. This is going to be also important if there is an outlier such as inflation expectations going higher. That could be problematic. But absent of any outliers in the data, the focus will be on OpEx. So why don't we rest right now, take a breather, sleep a little bit, and then we'll be back at it again tomorrow. This is all I got for you for now, folks. Thank you for listening. Thank you for watching. Appreciate and love all of you. Good luck tomorrow. I'll be talking to you again via chatting on Discord tomorrow and over the weekend. But for now, good night.
Just let me go.